All right, let's kick things off. Andrew, if you can go to the next slide, please. All right, as you can see from this slide, this is our fourth webinar in a series of 5 webinars on forestry taxes. This effort has been put together by several partners. Next slide, please. As we get going, you should have seen when you joined today's webinar, you would have got this screen on the portal. At the end of the webinar, we ask that you go back to that and click on step 2, complete the webinar. A survey should launch inside your, it's embedded within the web page. We ask that you complete that survey. If you're looking for your continuing education credits, you'll need to do the survey as well as a form certifying that you've completed the webinar, and it will gather some information from you in order to provide you a certificate indicating you've earned those credits. Next, please. Our partners for this webinar, as you can see, is quite a few folks from many different extension programs, as well as the USDA Forest Service, and contributing partners such as the Forest Landowner Foundation. Next slide, please. You can find, not alone this webinar series, but as well as a series of webinars that we've been doing under this topics of the Woodland Stewards since 2019 at this web address, and we will get that posted in the chat here for you in a little bit. Next slide, please. For today's webinar, we ask if you have questions to please enter them into the Q&A feature. You do that by clicking on the Q&A icon at the bottom of your screen. You'll see that there in the Zoom window. Click on it, go ahead and type in your answer, and we'll either try to answer it live or we will try to answer directly to you depending on the question. I will apologize now because I know we'll have many more questions than we can address today, but we will try our best to get through as many questions as possible. So please do not hesitate to ask your questions during today's webinar. Next slide, please. All right, to kick things off, today's webinar topic is about keeping more of your income following a timber sale. And we have 2 presenters today. The first presenter is Andrew Bosserman, who is an attorney at law, who will be talking first, and then Yanshu Lee, who is a professor of forest taxation and economics, and then we'll turn it over to you guys. And with that, Andrew, I'm going to turn it over to you.
Great. Thank you, Bob. And like Bob said, my name is Andrew Bosserman, and I am a tax attorney, a CPA, a former IRS agent, and I also owned a small Christmas tree farm for a while, which is how I learned about timber taxes, because actually, as I'll show you later, Christmas trees are actually considered timber under the Internal Revenue Code. But I'm excited to be here and to help you understand how to keep more of your income following a timber sale. And also, I'll let you know right off the bat, we have lots of slides to go through. So I definitely recommend downloading the slide deck, because you'll definitely want to refer to it afterwards, because we won't have time to go into detail on everything in the slides. So with that said, just a quick note before we get started. The information we're going over today in today's presentation is not legal or accounting advice. Tax situations are extremely complex, and everyone's tax situation is different. So what might be right for most people to save taxes might not be right for you. So you'll definitely want to discuss with your legal or accounting professional before implementing any of the tax information that we're going to share in this webinar this afternoon. And like I said, this is just another reiteration of what I just said. So first, we're talking about timber sales today, and there's going to be 2 important determinations you're going to make whenever you harvest timber and sell it. The number one thing is going to be the type of income. And there's really 2 types of income, which I'm going to discuss very shortly. They're ordinary income and capital gain income. And you're going to see why that distinction is important. And then the other important thing will be to calculate your taxable timber income. So you're not actually taxed on the gross amount of your timber sales. You are allowed to deduct some expenses, such as timber sale expenses, which would, if you have consulting forester expenses, attorney's fees to draw up a contract, things like that directly related to the timber sale. And then you're also allowed to deduct your timber basis. And we went over into basis in depth in our webinar last week. So if you weren't here, I definitely recommend you watch the recording and download the slides, because timber basis is extremely important. So I mentioned determining what type of income your timber sale qualifies as is extremely important. And this is why it matters. So let's talk about what the difference is. So ordinary income is held ordinary for a good reason. It's what many of us think as income. It's income from a job, wages, it's interest, self-employment income. It's pretty much all income other than capital gain income, which I'll describe here shortly. The other thing about ordinary income is that's taxed at the highest rates. So anytime you hear tax rates discussed in the news, they're generally talking about ordinary income rates, which currently range from 10 to 37%. And the other important thing to note about ordinary income is that it may be subject to employment taxes if you are actively earning that income. So like wages and self-employment income, they are subject to employment taxes because you're actively earning that income. And employment taxes are those Social Security, Medicare taxes that you'll see taken out of your paycheck. The other type of income is capital gain income, and more specifically, long-term capital gain income. And a long-term capital gain is the profit from the sale of an investment held more than 1 year. And many of you have likely had this income before, because it's most frequently seen if you've ever held a share of stock for more than 1 year and sold it. That's a long-term capital gain. And the thing we like about long-term capital gains is that they're taxed at preferential rates, meaning lower rates than ordinary income. So currently those rates for long-term capital gains range from 0 to 15%. And they're also not subject to employment taxes. And the best news of all is that timber sales can qualify to be long-term capital gains rather than ordinary income. So let's look a little bit closer about why capital gains are so important. Let's just look at the rates very quickly. So on the leftmost column, you'll see the current tax brackets if you're married, filing joint, and these are 2021. So as you're filing your tax return this spring, these are the income tax rates. The center column is the ordinary income rates I just described from 10 to 37%. And then on the right there, which I've boxed and set out, is the long-term rates that range from 0 to 15%. So just as an example, say you had taxable income of $100,000, that would be the third row from the bottom. You would be paying 22% at an ordinary income rate versus 15% for long-term capital gains. So that's a 7% difference there, which is pretty big. But it's important to note that oftentimes ordinary income, especially if you're in the trade or business of selling timber, will also be subject to self-employment tax. And like I noted at the bottom, self-employment tax is an additional 15.3% on top of the above ordinary income rates. So that 22% really turns into 37.3%. So as you can see, if we can get to the capital gains rates versus ordinary income rates plus the self-employment tax, that's a huge difference and can result in major tax savings, especially if you're operating your forest activity as a business. So how do we qualify for capital gains treatment? Because we've gone through that, it's much more preferential. You want to, qualify for capital gains treatment because you'll save a lot of money. There's really 4 areas we need to go through. First is your timber classification. We went over that in the first webinar in this series. I went through the 3 different types of activities, which are personal, investment, and business. So that's an important classification. You'll also want to look at your timber holding period. That's how long you've owned or had the right to cut the timber for. The third thing we'll look at is the timber disposal method. So there's a number of different ways you can dispose of timber. You can sell it on the stump, you can cut it yourself and transform it into other products. There can be a pay as cut contract. So a number of different methods, which we'll go through. And then also, you might have to make an election on your tax return to qualify for capital gain treatment. An election is, it doesn't mean the treatment is automatic. An election means you actually have to do something on your tax return, sometime attach a statement or check a box or something extra to tell the IRS, I want my income to be treated this way. So first, let's look for timber held for investment or personal use. So this doesn't mean you're in an active trade or business, investment or personal use. So timber is going to be considered a capital asset, and that income from a timber sale is going to be a capital gain regardless of how you dispose of it. So this is pretty easy. If you hold your timber for investment or personal use, then it's always going to be a capital gain. So that's pretty straightforward. We'll talk more about how you might have to report it, which will be important. But next, if you hold timber for use or sale in a trade or business, so it's not considered a capital asset because it's basically, if you're using it for sale in a trade or business, the IRS kind of looks at it like it's inventory, and generally business income is going to generate ordinary income, like I mentioned. So there's higher rates plus the addition of self-employment tax. However, fortunately, Congress passed Internal Revenue Code section 631, which says timber sales can qualify as long-term capital gain income if your holding period is met to make it a long-term capital gain, which means you've held it for more than 1 year. And if it qualifies under IRC 631A, an election is made if necessary. So let's talk about, I already mentioned holding periods. This is important because we know it has to be more than 1 year. So if you purchase the timber, like it says right there, you must have owned it for more than 1 year to qualify for long-term capital gains. So that's pretty straightforward. If you've received the timber as a gift, then the donor and donee's time is added together to determine the holding period. This is what's known in tax law as a tacked holding period, meaning the person who received the gift gets to tack their holding period onto the person who gave them the gift. So as long as both of them, when you combine the period of ownership together, is more than 1 year, then it will qualify as long-term capital gain, assuming everything else is met. And then for inherited timber, there's actually no holding period requirement. It's just automatically long-term. So that's pretty straightforward. Okay, let's get into the different methods of disposal. So there's really 3 different types of methods under the Internal Revenue Code. There is a lump sum sale. There's a pay as cut sale, which is also sometimes known as a disposal with a retained economic interest, but we'll go into that more and explain exactly what that means. And then you can also convert standing timber into products for sale. So let's get started on the first one. A lump sum sale. So this is probably the most common type of timber sale because you're selling standing timber for a fixed total amount, that's agreed upon in advance. So oftentimes you'll have a contract with a logging company or someone else, and you, sell them the standing timber, however many acres or certain tracts or whatever it might be, for a fixed total amount. And basically, once the contract is signed, title transfers to the timber. So if you're the forest landowner, once the contract is signed, you don't own title to the timber anymore. The logging company or whoever you sold it to does. The other important thing to note is that this can qualify for capital gain treatment, even though you're in a trade or business. So like it says in that bubble all the way to the right, like I mentioned before, the the important things about IRC 631 is that even if you own timber in a trader business, it'll qualify for capital gain treatment. And you can get those lower rates and save a lot of taxes as compared to treating it as ordinary business income. So lump sum sales are handled under IRC 631B. So let's go through some terminology. So to qualify for this, you actually have to be considered the owner of the timber. So it doesn't mean you necessarily have to own it outright or own it what we might call fee simple in legal terms, but you must own an interest in the timber before entering into the contract. So you don't necessarily have to own it outright. You can actually just have the right to cut the timber. So maybe you entered into a contract for the right to cut the timber with the actual forest landowner, but you must be considered an owner under this provision of the Internal Revenue Code. And also, like I mentioned at the bottom, timber for these purposes for 631B and also IRC 631A includes Christmas trees. So I know this presentation doesn't go into Christmas trees, and I think many of you are forest landowners rather than Christmas tree growers, but just know that if you also own Christmas trees, then those can qualify for capital gain treatment as well. However, there are some nuances to capital gain taxation for Christmas trees because depending on what type of farm you have, whether it's wholesale or a choose and cut farm where actually customers come to your farm and cut it down, there's a few special things to be aware of. So we're not going to talk about that in this presentation, but be aware you'll want to reach out to someone to learn more about that. And maybe in the future, we'll do a webinar on Christmas trees also. So more about the lump sum sale. So timber qualifying under Section 631B in a lump sum sale is what's known as Section 1231 property. And 1231 property is really the best of both worlds in the Internal Revenue Code, because if you have a net gain, it's treated as long-term capital gain, meaning you get those lower tax rates. But if you have a loss, which hopefully you don't, but if you do, it's actually treated as an ordinary loss, meaning that it will offset the more higher tax rate income, such as it could offset income from wages or interest or something like that. So, but the important thing to note is that with capital gains, a gain or loss from the disposal of timber is going to be aggregated with other Section 1231 gains. So say you have multiple timber properties and had multiple sales that qualified under this, the gains or loss would be aggregated together before determining if you had a net gain or a net loss for terms of long-term capital gain or ordinary loss. Or it could also be, you can get Section 1231 gains from other types of investments or other types of income. So it just wouldn't have to be other timber sales that you can net them with. So if you're an investor, this is the general way of how it's going to be reported on your tax return. So you're going to report a capital gain if you're an investor, or personal. This would be if you have a personal capital gain too. On Form 8949, which then flows to your Schedule D on your individual Form 1040. So it's going to go in the basics, but there's a long-term section on Schedule D. And assuming it's a long-term capital gain, that's what you want, a long-term capital gain, because that qualifies for those lower tax rates. A short-term capital gain, which you haven't really talked about, but a short-term capital gain is just taxed as ordinary income. So getting a holding period of more than 1 year on your timber that you're selling is extremely important, because without it, you cannot qualify for capital gain treatment. And also, a short-term capital loss is not very beneficial to you because you're limited to a deduction of $3,000 per year on your tax return for a net short-term loss. But then again, these losses all get mixed together. So other capital gains you have and other losses, these will all get netted together on this Schedule D on your individual income tax return. Another important thing to remember is that you're going to want to at least fill out Form T, because filling it out actually helps you prepare your tax return. So according to IRS publications and the instruction to Form T, you don't need to file Form T if you're only an occasional seller of timber. And the IRS defines that as, 1 or 2 sales every 3 or 4 years, I think. So if you only have a timber sale, every couple of years, you're actually not required to file Form T. But it's actually still good practice to fill it out because it goes through the depletion calculation, which we discussed last week. And also tracks your basis. So I would recommend filling it out, even if you don't necessarily have to file it with the IRS. And also generally, you should expect to receive a Form 1099-S if you sold timber. And that's just one of those informational reporting forms that the IRS requires people to file. This is if you're holding it in a trade or business. So very similar to how it's reported if you're an investor or a personal activity that sold timber. But the difference is you're going to start on Form 4797, which is titled Sales of Business Property. But then on that form, it gets combined with other gains and losses and then gets transferred over to Schedule D, just like a investment or personal gain would be as well. And then the following steps are all the same. But if you're in a trade or business, you likely have to file Form T because you're regularly selling timber. So I would say most forest landowners who operate a trade or business probably have to file Form T, but that's not an absolute for every situation. You should definitely consult with your tax professional. Okay, here's an example just to make sure we understand the math. So Ms. Johnson sold hardwood standing timber she inherited 10 years ago for $12,000. It's an investment for her. Her selling expenses were $500 and the timber's adjusted basis was $4,000. What is her taxable gain and how is it reported? So just a basic example to explain what I've been talking about. So her gross proceeds were $12,000. And then, like I talked about at the very beginning, you subtract out sale expenses. So in this instance, $500. And also her timber basis on what she sold, which is $4,000. So she has a net capital gain of $7,500. And she's going to report this gain, like I talked about in Form 8949, which flows through the Schedule D and then to the tax return to get taxed. And then she should also complete Form T and file it if she's required. So that's the end of lump sum sales. And I'm going to quickly talk about pay as cut sales. So as opposed to a sale of standing timber, a pay as cut sale is you have a contract that gives a rate for each unit cut. So you're not selling a specific volume straight away. Basically, the logger who's ever harvesting the timber is going to pay you an amount per board foot or ton or some other measurement of timber. And generally in this instance, the forest landowners retain the title to the timber until the loss is cut. So in this instance, you should actually use Form 4797 to report income on a pay-as-cut timber sale, regardless of your holding status. And also, basically, this also qualifies under Section 631B of the Internal Revenue Code. So same provision as a lump sum sale, just different application. I don't think these kinds of sales are quite as popular as sales of standing timber. So this is just a really brief overview of pay and cut sales. But if you have one, you should definitely speak with your accountant and attorney. You should probably always speak with your attorney before you enter into some sort of timber harvesting contract, because these contracts are important, can have tax or legal implications. So definitely recommend doing that. But now we're going to get into converting standing timber, and Yanshu is going to take it from here. So I will stop sharing. Yanshu, take it away.
Yes, thank you, Andrew. Like Andrew said, he covered mainly two major methods of timber sale, lump sum and pay as cut. And there is another way of selling your timber, and that is converting standing timber into products and then sell it. And this is not prevalent in many small landowners, but it does exist for some business. For example, you probably you cut your standing timber, or you hire some loggers to your property and cut the standing timber and convert it into logs or other like lumber and all those other products and sell it either to the mills or those, and then receive the income. If you receive income and you didn't make a special election, then all those income or profit will be subject to ordinary income tax rate. So it's very important to make a special election, which is Section 631A election. And how do you make the election? Basically, you use Form T, Part 2, and then make this election, and then do the calculation properly. And that's the way you make this Section 631A election. And only in this way, you can enjoy treating part of your gain or income from this sale as a long-term capital gain. And if you make the election, then your income from the timber sale, from selling the cut products will be divided into two parts, basically. And the first part is the gain from holding your timber property, your standing timber. That will be treated as a capital gain. And if it requires you have to hold it for more than 1 year, and that will be long-term capital gain. And then the second part is profit from selling the standing timber convert the standing timber into cut products and then sell the cut products to the mill. That will be treated as ordinary income and taxed at a higher ordinary income tax rate. It's more like you're selling yourself standing timber on the first day of your tax year, and for if you are using calendar year, then it's like you're selling yourself the standing timber on January the 1st of that year, and then convert it and then sell it. And inherently, it's a business practice, and most of the if you're holding timber as an investment, this is not the popular methods to sell your timber. And basically, you need to calculate the profit of holding your standing timber. You need to have someone qualified appraiser to estimate the fair market value of the standing timber on the first day of the tax year or the calendar year, and then calculate the difference between the fair market value and your adjusted timber on the first day of the year, and that portion will be long-term capital gain. And then, like Andrew said, and then that will be Section 1231 gain if you have if your revenue is more than basis, and if it's a loss, then if it's less, then it's a loss. And then, just like Andrew mentioned, you need to aggregate it with other Section 1231 gain and loss, and then figure out whether it's a capital gain or it's an ordinary income. And then report the second portion of the profit, which is the difference between the revenue or the price of cut products and the fair market of the standing timber, and that portion should be ordinary income. And in your slides, you will see an example of basically a landowner hired a logger to cut his timber, and then he directs the logger to sell the logs to a mill, a local sawmill. for $20,000 in 2021, and then he paid the $500 for consulting fee, and also assume the fair market value of the standing timber on the first day of 2021 was $15,000, and then its adjusted basis for the sold timber was $2,000, and he paid logger $2,000 as a cut and hauling cost. And here is a way to basically show you how to calculate the long-term capital gain, or we call it Section 1231 gain from holding the standing timber. The fair market value of the standing timber on the first day of the year minus consulting fee minus adjusted basis, and that portion, because it's greater than zero, that portion is a gain. It's treated as capital gain. And then the second part of the revenue or the profit is the difference between the price he received from the mill minus the fair market of the standing timber on the first day of the year, and then minus what he paid for the logger, and the difference is $30,000, and that is subject to ordinary income tax rate. So it's important to separate the profit into those two parts, and you can see the importance of making the election. Otherwise, all the revenues, all the profit will be subject to higher ordinary income tax rate. And with that, we covered the income from timber sale. And sometimes you landowners, or you could also receive income from selling other forest products like pine straw in Georgia. Pine straw is a very important source of income, and also hunting lease. I know in some parts, in the north part of the country, selling maple syrup is a very important source of revenue, and normally income from those products are classified as ordinary income, and is subject to ordinary income tax rate. And those are the major income from timber and forest products sale. And sometimes you may receive cost share payments from government agencies or some organizations. And if there is a special provision that is available for landowners for you to see if it's beneficial to you to exclude that payment or that income, but that's only applicable to certain payments from certain qualified government agencies. Generally, you are required to include all the cost share payments into your taxable income. You need to pay a tax on those income, but with the special provision, we call it Section 126, certain payments could be excluded from your taxable income. And like I said, in order to be excluded, it has to be from a approved qualified agency, and it has to be from a qualified program. And the payment has to be for capital projects. For example, for us as landowners, one of the major capital projects are reforestation, and the purpose has to be for conservation purpose. And these are the existing or currently active excludable cost share payment, cost share programs at the federal level. For example, Forest Health Protection Program. This is a federal program, but in different states, normally the state forestry agency, they use the funding and they administer the funding and provide assistance and in the financial and all those, and sometimes they put the different names for those programs. So it's important for you to check with your state forestry agency to make sure, even though they got different names, but they are still qualifying program. For example, as I know in Georgia and Texas, we have a Southern Pine Beetle program that is actually under the Federal Forest Health Protection Program. Those are the qualifying cost share programs and the conservation CRP program. And sometimes you may receive cost share assistance from CRP program. And if it's for reforestation or capital projects, and those are eligible Section 126 cost share program. But keep in mind the annual rental payments is not qualified. So if you just receive the annual payment for using your land to conserve, those are not qualifying payment. You need to include it in your income and pay ordinary income tax rate, ordinary income tax on those annual rental payment. And the EQIP is another popular federal program. They provide a lot of cost share assistance to like for reforestation, those projects, and those are also qualifying cost share programs. And currently there are long leaf initiatives under EQIP, and those are also qualifying initiatives. And the wildlife habitat incentive programs is not active anymore. They are now aggregated into the EQIP program. So if you can check with them, and the wetland reserve program. Those are the popular federal programs that are that normally provide cost share assistance to private landowners. And if you receive payment from them, you are eligible for excluding the cost share payment from your taxable income. And those are the here is some examples of qualifying state programs. For example, in Mississippi, the Forest Resource Development Program, if you receive cost share assistance payment from this program, you are eligible to exclude the payment from the program from your income, your taxable income. And also there are other qualifying state cost share programs, and it better to check with your. It would be better to check with the program coordinator to make sure they are eligible for the exclusion. And this is not exhaustive. As far as I know, at least 15 to 20 states, they provide qualifying cost share programs under Section 126. So better to check with the program coordinator. And even though you're eligible or to exclude, it's not like full amount of the payment can be excluded. There is a formula. You can only exclude part or sometimes full amount of the cost share payment from your income. This is the way the code says. It's quite confusing, but basically you need to do a calculation following 4 steps. The first step, you need to calculate the 10% of the average annual income from your affected acreage of timberland in the past 3 years. And second step, you calculate the amount of income receiving $2.5 per acre and multiply by the acreage. affected acreage. And then compare those two numbers, and the larger number divided by a applicable interest rate. And the code doesn't specify what is the applicable interest rate. You have to justify the applicable interest rate to you. And each year the IRS release the farm credit bank interest rate. They kind of accept this rate as an approximation of your interest rate for this calculation. And then the number from step 3 will be compared with your cost share payment you received. And then you can exclude the smaller amount of those, the number from 3. So it's quite complicated. You don't need to remember all those, but keep those in file in case you receive the payment. Then you can do the calculation, or you share this with your tax advisor to see if it's worthwhile to exclude the income or the payment from your cost share program. And here is basically an example showing how to do the calculation. You don't need to do all those calculations. Just keep it in your file and then share it with your tax advisor later on if you have the situation. When you compare those two examples, it's important to notice whether you have received income in the past 3 years actually affects how much you can exclude. So if you decide to exclude the cost share payment, then you need to attach a statement with your tax return. Basically, tell them what kind of program is that, and how it's a qualified program, and how much payment you have received, and the date, and how you calculate the excludable amount. And if you sell the timber, if you choose to exclude the part or all of the cost share payment under section 126, and then later on you dispose the timber within 20 years, then there is a special recapture provision. So just keep it in mind. There's no one rule fits all whether you should include or exclude the cost share payment. Basically, you need to consider several factors. First thing is whether you have received income on the property in the past 3 years, because that kind of put a limit when you do the calculation. And also, how long are you going to hold the property? Because of the recapture provision, if you plan to sell the timber within 20 years, then probably it's better to include the cost share payment in your income, so you are not subject to recapture provision later on. And then also, you need to do the calculation with or without including it in your taxable income, because your income tax bracket, both the state income tax bracket and the federal income tax bracket, play a very important role in the whole process. So again, there's no rule of thumb for this. You need to do the calculation and also factoring all your plan for the property. And that is what I'm going to cover. And if you have any questions, just let us know. Thank you.
Thank you both, Andrew and Yanshu. Great presentation. Folks, at this time, we're going to start going through questions. We have quite a few questions that have been entered into the Q&A feature. Remember, if you have questions, please type them into the Q&A, and we'll do our best over the next 15 minutes here to try to address as many questions as possible. If we don't get to your question, the best place to reach out to for answering your questions, you can reach out to your local extension office, but really a tax advisor who has experience with forest taxes is the best place to go, since each situation is often unique. And with that, we'll get started with our questions. So the first one is from Dan D. And the question is, if the owner sold timber less than 1 year from the time he bought the property, is there still a financial benefit if the income is filed as a short-term capital gain?
Yeah, so this is a good question, because we didn't really go into short-term capital gains too much, but I know I mentioned once that a short-term capital gain is taxed the same as ordinary income. So generally, in almost every situation, there isn't a financial benefit because you'd be paying those higher income tax rates. However, there is one situation where it might make sense, and that would be if you had lots of carry forward short-term capital losses. So if you have a short-term capital loss, you can only deduct up to $3,000 of those on your tax return a year, a net short-term capital loss. And then any excess will be carried forward to subsequent tax years. So the only way I could see it ever making sense to do a timber sale that results in short-term capital gain income is if you had lots of carry forward capital losses, because then that recognizing that income would free up the short-term losses and you essentially wouldn't pay any income on the timber sales. But that's one specific situation. Generally, it will be best to wait more than a year.
All right, thanks, Andrew. Next one is from Doris Stamper. They have income that definitely qualified for capital gains income, but they received a 1099 indicating business income. How do they report it?
Yeah, you should report it how you think it should be reported. So if you think it qualifies for capital gain income, report it that way. You know, it is common that mistakes are made on these tax filing forms because it's you know, other companies making the tax determination. As long as the income's reported on the return somewhere, generally the IRS doesn't have a problem matching it up. So you should report. This goes for any tax form. Report it how you think it should be reported on your tax return, because mistakes can be made on the tax filing forms.
All right, next question is from Tim Morgan. If a timber sale contract is signed and a down payment of 20% paid with the balance due in full before any trees are cut, when does the buyer take title to the trees? When the contract is signed with down payment or when the contract is paid in full?
So in this answer, it's going to be the classic lawyer answer of it depends, because there's a lot of things that go into this. So one, the contract itself might say when title is taken. So you want to look at that. And two, title will transfer also according to state law principles. So it can actually change based on what the law is in your state. So I would definitely look to the contract itself first, and then if not, probably the law in your state.
All right, another question from Dan D. And this one is, owner and his wife inherited property in 2009. They got divorced in 2020 and changed the deed to include himself only. Would the basis be back to 2020 or 2009?
Now we're getting into a complex situation. Good. So we talked about the different kinds of basis and definitely refer to them last week's presentation. But so in an inherited basis, you get the step up in basis, but we never talked about a divorced basis,
Yeah.
but generally that is treated the same as a gift. So it's known as carryover basis. So if you get property from your spouse in a divorce, generally you take their basis in the property. So in this situation, it sounded like it would go, since you take the carryover basis, it wouldn't be the basis as of, it would be the spouse's basis as of the divorce. So there's not going to be any step up or anything due to getting divorced. You'll have to actually look at what the spouse's basis is.
All right, thank you. Here's one from Gregory Cox. How would forest carbon income be taxed?
I think last time we kind of answered this question, and basically right now there's no clear guidance from IRS on how to treat the income from carbon, forest carbon. But from the private rulings, what we can learn is they normally treat the payment from producing forest carbon as the ordinary income, as rent income. So you need to pay ordinary income, pay tax at the ordinary income tax rate, very likely. That's the case.
Yeah, I spoke with NCX about a week ago, and they're still not sure either. So that's one of the carbon issuing programs, and they're telling all of their clients to go ahead and do it as ordinary. And if they find out that it gets better treatment, then you can claw some of that back. But for now, to go ahead as ordinary, like Yanshu said.
All right, next question from anonymous attendee. What if seller enters into agreement where buyer pays seller X dollars upfront and buyer has the right to cut timber for X amount per ton for a certain time period? The buyer pays seller for any timber value cut exceeding the advance payment. Risk is on buyer to cut at least the amount of the advance payment, but any quantity cut exceeding the advance payment is due to seller.
Yeah, so this, just based on those facts, it sounds like a pay as cut agreement to me, because it's not a lump sum sale because the title doesn't transfer immediately. It sounds like the title transfers when the trees are cut. And if no trees are cut, then they still remain the forest landowner's property. So just based on that short factual statement, it sounds, even though it might be slightly different than the example we gave, it sounds like a pay as cut contract to me.
All right, next question is from Jib Davidson. If timber sales are classified as capital gain income, if the tops and branches from those trees are chipped, then the chip should also qualify as capital gain income, correct?
For federal income tax purpose, the timber actually means the bow, the standing timber that could be used to produce log or lumber products. And if the tops and the branches are part of the whole process, then it qualifies as a capital gain. But if it's processed separately, then it's an ordinary income.
Okay, thank you. This one is from Vivian. Is CSP an excludable cost share program?
I suppose it's a conservation stewardship program. Yes, it is a excludable cost share program, but it also depends on what kind of payment you're receiving. If it's for like a improvement of the land, then it's not. But if it's for reforestation, yes, it is.
Okay, next question from an anonymous attendee. Can you clarify, did you say that if you sell timber under a pay as cut arrangement, it is always reported on form 4797 regardless of timber activity classification?
Yes, that is what we said. So it's kind of counterintuitive because the form says sales of business property. But yes, it should be reported on form 4797. That's what our slide said. But really, ultimately, Form 47, everything flows through to your Schedule D on your tax return. So let's say you even were to make a mistake on this, it actually wouldn't have any tax impact because it would all go through your Schedule D and be taxed the same, because Form 4797 is really a informational form. So it would likely be taxed the same. I mean, you should report it correctly, but I'm just saying.
All right. From Jim Davidson, just trying to clarify, it looks like, not trying to be difficult, but there are times when we, the same crew, harvest the hardwood in chip form and then return to harvest the roundwood. We have done that many times. I would think it would be based on how the contract is set up, correct? So if they
Yeah.
set it up all as one contract, it doesn't matter how many trips you go to the woods to get the roundwood versus the chips.
Mm.
It's if you have two different contracts, one for chipping tops and branches, things like that, would be treated then differently, correct?
That was kind of my take on it, is that if it's all going, if it's the same logger going out and handling all of it, right, then I kind of viewed it as the same as capital for all of it. If it otherwise qualifies, not worried about where it goes, right? Because we merchandise products all the time, right? Some goes to the pole mill, some goes to chip and saw. It goes to different places. So where it was going didn't affect me so much. When the question, I guess, becomes how far apart are those trips and what would make you want to treat that chipping job differently? And I don't know if maybe Andrew has any clarity on that.
No, I mean, I think that sounds correct to me. It's going to be based on the contract, and also, if the sale was for the entire, standing timber, it seems like, if it's part of the act of harvesting, kind of like Yanchu alluded to, harvesting the entire tree, then it should qualify for capital gain. But yes, that's really getting into kind of some gray areas of the tax law.
All right, next question from Johnny. Cutting down timber firewood sales as a business and sold by the forest owner. In order to find best tax incentive, do I need to make a 631A election?
Yes, I think so.
Yeah, that sounds right to me. If you are cutting so Yanchu discussed 631A, but you need to make the election for 631A if you're cutting it yourself or you're paying someone to cut it for you, which is what it sounds like in this instance. And remember, for 631A, you actually have to make the election, and not like 631B, where it's you just report the on your return. But I see the question says that it's also talking about changing the election. So that's true. Once you make a 631A election, then you have to ask the IRS's permission to change back, because that election will apply to all future years. However, that would only apply in situations for 631A. So even though you made a 631A election, you could still sell timber under 631B, say standing timber in a lump sum sale or a pay as cut contract. And the IRC 631A election wouldn't affect that. It's kind of two separate roads you go down depending on how it's being harvested.
All right, thank you. From Dan D. How do you treat a lump sum sale where installment payments are made in 2 tax years, but it was only harvested in 1 year? The owner received 1099-S forms each year.
So one of these things, which I don't know if we talked about this in any of the previous webinars, is it's going to be based on your method of accounting. We didn't go into this, but there's 2 methods of accounting: cash and accrual. Most individual taxpayers, you have to be cash basis, meaning you report income when you receive it. So in this instance, you'd have to report it in 2 separate years. It is possible, if this is a business, you could actually be on the accrual method, meaning you basically recognize income when it's earned, regardless of when the payments are actually made. But assuming this sounds like you're probably a cash basis taxpayer, you'd have to recognize the payments in both years as income, and kind of like on an installment sale method. But I don't know if Yanshu wants to add anything else to that.
Oh, no, I think that's exactly what I think.
Okay, our last question from anonymous attendee. If the seller receives a lump sum payment for a timber sale, can he have the entire payment placed in an escrow account by the timber buyer to be paid out to the seller over multiple year times?
Is it an installment sale? Andrew.
Let me, sorry, I'm just reading the question again to make
Yeah.
sure I understand it.
It sounds like we're just putting the money in an account and then divvying it out when to kind of minimize taxes or spread out.
Yeah, so generally, I mean, if the seller received the entire payment, regardless if it's placed in an escrow account or not to be paid somewhere else, you've received that entire lump sum, so it's going to be taxable. It's known as the like constructive receipt doctrine in tax law, but you know, if you have the right, if you receive that income or have the right to control it, it's all going to be taxable regardless of if you like divert it to another account or to another person. So I think that's what that question is getting at. It's likely going to be all taxable in the first year.
All right, thank you. At this time, we've answered all the questions. It is just a minute after 2, so I'd like to wrap this up. I want to thank our presenters today for a wonderful job on their and the wealth of information they shared with us. Thank you both. Reminder, we have another webinar in a week, same time, next Tuesday, which will be wrapping up our series. So please join us at that time. And with that, thank you all.